lawmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the White House says President Trump is likely to speak this week with Chinese leader Xi Jinping as the two economies remain locked in trade turmoil.
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls.
We're joined by Rosalind Matheson, our EMEA news director, and then in a second we'll speak to Janet Henry. So there's a lot going on, of course, as always, Ros, in terms of trade. There doesn't seem to be a massive breakthrough. I mean, it's been 2 months since actually we heard what Donald Trump wanted to do. What's the way forward? Like, what are the main sticking points?
Well, with China, they're complex and they're many. And it's interesting to see the US officials talking repeatedly about the prospect of a phone call this week between Donald Trump and Xi Jinping. It's almost like they're trying to will this call into life. And it's been radio silence from China, I guess, unsurprising. But for Xi Jinping, the real question is he's not going to rush to a call unless he has a clear sense of what he's going to get out of it. But it does reflect, as you say, like months on, we've got a bit of a framework deal with China that's wobbling heavily, accusations on either side of breaching understandings, US, criticising China over rare earths, China bringing everything in the relationship into it in response, including student visas, including AI chips, you name it. So that doesn't seem to be moving anywhere. Meanwhile, very slow-moving, complex negotiations with the EU. Again, a lot of conversations, but not a lot of progress. And, Donald Trump's coming up against a lot of self-imposed deadlines here to get a lot of deals done, or at least framework understandings done. And so far, what has he really got on the table? The UK, which was arguably a fairly easy one to achieve, but a lot of hard stuff still very much on the table.
Ros, first of all, the overarching, basically, theme of trade, do we have a better understanding how the Trump administration is trying to get through it?
Well, we do and we don't. We can see the negotiating styles that are coming in from the US. We can see how countries in turn are learning how to deal with the US in response, and looking at some of the examples and saying, well, you need to some extent, stand up for yourself against the US. And that response is somewhat respected by the US, even if it makes the conversation more difficult. But again, what is it that fundamentally the US is trying to achieve here? Donald Trump went into the election with a bunch of promises that he made to the American people, and he's trying to show that he's enacting on those promises. And, how he gets there is for him probably less important than trying to get there and show that he's getting there. And meantime, you can see in the US economy, the concerns are coming in about the impact of this whiplash on trade, on sentiment, on jobs, on companies, on behaviour. So he's got a very close eye on that as well. And he's clearly just trying to get some sort of announcement out there in the coming days.
Ros, thank you so much. As always, Ros Matheson there on the politics of the trade war. She is director, our EMEA news desk. Now, joining us is Janet Henry, chief global economist at HSBC, to understand the implication that has on inflation, monetary policy, and many other things. Janet, as always, thank you for joining us. I mean, because of the trade uncertainty, how difficult is it to set the right monetary policy right now?
Very, very hard indeed, which is why what we're hearing from central banks, particularly from the Fed, we need to wait and see. And that's why they are going to very much wait on the sidelines. And as Ros was saying, there's so many complexities to a lot of these discussions that President Trump is having, or his administration is having, with various countries. And while we've got this July 9th deadline at which the pause ends, we really don't know whether we'll then get the step up in the reciprocal tariffs thereafter. And clearly markets have taken the view that tariffs are now primarily a negotiating tactic and we're not going to be ratcheted up again. But the recent path has shown we really can't be sure what is going to happen tomorrow. So central banks have to stick to their mandate. And their mandate, in the case of the ECB, is price stability. For the Fed, they have to balance the two. And if inflation is still a little bit above target and the economy is still at full employment, you just wait on the sidelines until one of those tips the balance towards trying to set policy. And for now, it's all about inflation expectations.
Yeah, and that's the messaging clearly from the Fed and numerous Fed governors, right, that they worry about an uptick in inflation in the third and fourth quarter. Is there a danger that some of the things that we were expecting to show up in the data is not showing up? Is that because there's something structurally with the economy, or is it just being delayed?
Well, that's the question I am asked most frequently by investors. They say, when will these awful surveys show up in the hard data? And what we saw in the April surveys was that they absolutely tumbled. Some of them were at COVID type of levels in terms of consumer confidence and business confidence. And then they revived a little bit in May. Now, we haven't even got the May labour market data. We'll get that on Friday. And I think you are going to still have this difference between survey data, which is now stabilised but not back where it was, because maybe people are thinking, well, maybe this isn't really going to happen for sure, and then the uncertainty impact. Yes, you're not seeing mass firings at this stage, but you're certainly seeing a slowdown in hiring. But the Fed also has to consider what's happening to the supply of labour against a backdrop of potentially slower immigration. But certainly on our outlook, we've got the worst point for growth being the fourth quarter and the first quarter. Some of it's the impact of higher inflation weighing on consumer spending and real incomes, and then you get the impact of much weaker hiring and a potential increase in unemployment leads to the sharper weakening of growth.
So are you expecting a cut from the Fed?
Yes, we still have cuts. Well, by the end of 2026, we have a bit less than is priced into the market. We've got 75 basis points of rate cuts, but obviously the market has repriced to some degree because, of course, in 2026, you've got the additional complications of what happens to the budget reconciliation bill and when that takes effect, and, of course, a new Fed chair next year. But based on that view, now that we might get a little bit of fiscal stimulus next year, actually, I think some of the prospects for bigger rate cuts next year are overdone. Actually, I don't think the Fed will be easing through 2026 because the growth may be disappointing, but the inflation numbers will still be quite sticky.
Janet, you mentioned the ECB. I mean, it's the big one. After they cut rates, now on Thursday, or in June, actually, which is pretty much priced in, what happens?
What happens? Well, a lot of that depends on what happens in terms of legislation or executive orders generated by the White House. So I think they sit and wait. And absolutely, we're going to get a great inflation number. It could even fall below 2%. So that will be helpful. The ECB has been clear that they are in neutral territory already at 2.25. We get the cut today to take it to on Thursday to get the 2% level. And I think they certainly are on hold in July before you have to take a view at later meetings. Are you seeing further downside risks to growth? Do you need more accommodative policy? But again, in no hurry, because there is going to be higher fiscal spending in Europe and core inflation is still at 2.5%. So they can afford to wait a little bit in the absence of a really disappointing growth outlook.
Because I guess, interest rates at 1.75 for the ECB, it must mean that the economy would be really in bad shape, right, to get to that level, or is that unfair?
Well, that's a little bit unfair. So I think it's, what they consider to be the neutral range is 1.75 to 2.25. There was a time not so long ago when people were saying, the ECB needs to slash rates to sub 1%. We got so used to rates being at that zero level. But I think 1.75 is still just about in neutral. Do they need to go super accommodative only if they see big downside risks to inflation? Europe's had weak growth for several years, but inflation has not been below target. And on their new projections, which is what the market will really have its eye on Thursday, how low do they go on inflation? Is it 1.7? Is it 1.8? When we look at 2026 and 2027, their mandate is very clear. And their forecast for growth will not have the fiscal impact in it, because they won't have had time to process that. And in Europe, you never quite know when the fiscal spending will hit the ground.
But, Janet, do you worry about inflation undershooting, basically 2% in the Eurozone for quite some time?
If there is an undershoot in Eurozone inflation, I suspect it will be primarily driven by what happens to energy prices. If core inflation is but obviously the ECB, they forecast headline inflation. But if core inflation is at 2.5%, you would need a severe weakening in demand against a backdrop of what is a complicated supply picture in terms of productivity and labour supply in Europe to lead to big downside surprises and undershooting in the Eurozone.
Janet, what do you worry about the most? So, we haven't talked about China or Japan, many concerns there, but also the UK. Is there something that we're missing, given all of the uncertainties?
Well, I think, the market always has to price in all of the available information as soon as it comes through. And I think, everyone's looking at the world knowing that this is unlikely to be good news, what is happening, what is underway globally, even if some of the worst case scenarios are not where they were perhaps on April the 2nd. So I think it has more become about the relative winners and the relative losers, who's less exposed to the US in terms of selling consumer goods or the sectors that are subject to those sector-specific tariffs. So, this is why some people are saying, well, actually, you mentioned Japan. It's still, a very large bond market. Maybe we'll reach a stage where there are opportunities there. Others have pointed to Australia. If only 4% of exports go to the US, obviously they need some domestic growth drivers if China's still going to be somewhat sluggish. So I think it's all about the relative stories in this world.
Okay, yeah. We could talk about this for another 2 hours. You'll have to come back, Janet. Thank you so much. Talking, as always, extremely insightful, talking about the relative values and the relative plays, given all these bifurcations. Janet Henry, Global Chief Economist at HSBC. Now, coming up, our interview with Bill Winters, the Chief Executive of Standard Chartered. We talk regulation, we talk tariffs, AI, and of course the company's outlook. That's next, and this is Bloomberg. Well, chip giant TSMC sees profit rising to a record high this year and is maintaining its sales growth outlook. The company also says there's strong demand for chips used in humanoid robots. Now, let's bring in Robert Lee, a senior analyst at Bloomberg Intelligence. Every time I say humanoid robot, I kind of slightly freak out. But what stands out, Robert, from TSM's results?
Okay, there was a lot of talk on different topics. I would say nothing substantially new, and in fact the stock actually traded off in the local session here in Taiwan. Having said that, it had been flirting with its 200-day moving average, so there's a technical line of resistance there, which is failing to break through in the short term. But there are a number of different areas covered. One was on the future locality of their fabs, and as I guess yourself and most of your viewers are aware, TSMC has committed $100 billion over the next 5 years to build out new fabs in Taiwan. The CEO actually shared some personal conversation he'd had with President Trump. President Trump's message was essentially, do your best, because building out $100 billion of fabs in 5 years is a very tight deadline. And the main issue that TSMC faces is finding the appropriately qualified production staff who can run these things. So that was one issue. They recommitted that Taiwan will remain central to their capex plans going forward. They referred to the local fabs there as their mother fab. In other words, they'll develop and perfect the technology before transferring elsewhere. But AI dominated the conversation. But overall, I think it was a steady as she goes sort of message. Some short-term impact maybe from the Taiwan dollar on their earnings. But again, that's well known and well factored given the moves we've seen in currency markets in recent weeks. So, but a reassuring message that steady as she goes and they remain bullish on the long-term outlook.
So meanwhile, Robert, Elon Musk is selling $5 billion in debt for his artificial intelligence startup. What more do we know?
Okay, well, what we know is that this $5 billion they're looking to raise, if that is confirmed, is likely to be part of an ongoing capex rollout plan at their so-called Colossal Fab, which is in Memphis in the US. They've currently got 200 to 300 GPUs installed at that facility. They're looking to add up to 1 million at an adjacent facility. So it's likely the funds raised will be in support of that. which reconfirms that CapEx remains strong. Although I would say, what about the monetization? I think that remains the elephant in the room here, and thing that investors need to continue to focus on, given the proliferation of free or low-price products in the market.
Robert, thank you so much. As always, Robert Lee there from Bloomberg Intelligence. Now, private credit firms enjoy a significant capital advantage over traditional banks. That's according to the chief executive of Standard Chartered, Bill Winters, who says banks have to deal with higher capital costs, and this won't change anytime soon. In a wide-ranging interview, as he marks a decade at the helm, Winters discussed UK bank regulation, the impact of tariffs, his own future, and the role of AI.
I think that the biggest challenge for an organization like ours is what are the use cases that are existential for us.
Right.
Because when you talk to, as I did, I spent a week on the West Coast 2 weeks ago of the US, and you talk to hundreds of people about their AI strategies, and there are thousands of absolutely, everybody's got a use case. We're all using ChatGPT or Claude or whatever. And the key is to focus. So what we've really tried to do is say, well, what are the one or two things within each of our key businesses that are existential for us? Because those things we have to build ourselves. We have to be at the cutting edge. For a lot of the rest of the stuff, RFP generators and file reconcilers and PowerPoint editing, we can take somebody else's application, bring it in.
Is that what you see as your ultimate job? Is
Yes.
If you look at trade tariffs, if you look at AI,
Yeah.
it's these big shifts in society.
That's right.
And that's what basically is that what gives you a certain buzz today?
It gives me a buzz. Those are also the imperatives. And if there's one thing that finding myself in the position where I've got a great team that runs the business day to day, every single day, and I've got a great chairman who's new, but the old chairman was also great. I'm in that middle zone where I can really think more strategically, and AI is a huge part of that.
How do you think about regulation?
It's interesting to see how that pendulum swings. So, I was on the UK Independent Commission on Banking back in 2010-11.
You were one of the architects, actually.
Well, for better or for worse, right? Out of that came ring fencing, but we made some assumptions at the time about the likelihood that the Basel Committee would continue to be pretty light touch in terms of the way that banks' risk was calculated. And as a result, we put structural recommendations in place, like ring fencing. Now, as it turns out, the Basel Committee has been super rigorous, and some would say too rigorous, but let's just say the Basel 3.1 endgame, for those of your listeners that aren't in banking, they'll know that's intended to be the last stage of bank capital regulation. It's pretty conservative, I would say. So the cost of capital for a bank is significantly higher than the cost of capital for a private credit company. Okay, that's just a reality. I don't think that's going to change anytime soon. The result of which is banks are disadvantaged lenders.
De facto, right.
De facto, and that's okay. And banks also have the opportunity to be very leveraged and take insured deposits.
But is that okay, or would you actually roll back some of the ring fencing?
Well, the ring fence, that's a different question. I know there's a debate now about whether the ring fence entity should be allowed to be bigger or take more deposits before you have to ring fence. I think those kinds of refinements make perfect sense. But the Bank of England did a review, or Keith Skak, I guess was the Treasury. Keith Skak did a review 3 years back on the ring fencing. I can't add much. I might talk to him quite a bit during that. Yeah, he said it's fine tuning, yes. Fundamental rethink, not necessary. I like the fact that UK banks that have ring-fence banks have different views on this. Well, okay.
Is there one regulation that you would get rid of if you're in charge today?
There's not one regulation that I would get rid of. I would say that we've erred on the side of very, very extensive micro-prudential supervision. We've got really huge numbers of individuals in the UK, in the PRA and the FCA, who are focusing on our business. And I think one, they're too intrusive. It's too costly, and two, I don't think you actually get a good return on that, because at some point the board and senior management start to think, well, if it's okay with the regulator, it must be okay, which is a terrible conclusion to reach. Of course, we don't make that consciously, but deep down, I think there's a risk that we get there. So,
but every day do you wake up to, of course, service your client, but is it to also have a fair share of beating the likes of JP Morgan? And actually, what needs to happen?
Thankfully, JP Morgan is one of our great partners, but
or someone else.
No, but I mean, we're an interesting bank because our biggest single customer base, broadly, is banks. other banks because we're a banker's bank. But of course, we also compete with them in many markets. No, I would like to wake up every morning, most mornings I do, thinking, how do we give a better service to our customers? If we get the customers right, including banks, if we get the customers right, the rest is going to follow.
So Standard Chartered is also known for its prowess in trade finance. How does this change because of the trade wars?
It's fascinating. Every day is a new adventure. If there's, I think we all have our assessment of what's likely to happen here, and a base case, call it the base case. And the base case that the whole market is assuming is there's going to be some increase in tariffs, maybe 8 or 9%, for 10% from the U.S., that the rest of the world, that China will be at 30% or something like that, with some gap, which means an ongoing evolution of this China plus one into all the markets that we call home. So. Of course, China is already adapting to that. China has been adapting to that for some time. With Chinese manufacturing, Chinese corporations have been moving to Malaysia, Vietnam, Indonesia, increasingly to India, fascinatingly, despite the geopolitical tensions there. So, we have a very important business in China, but most of it is cross-border. So, as Chinese corporations reach out to the rest of the world, and as international corporations are diversifying their own supply chains, they're going into the markets that we call home. So it's actually been feeding a lot of our growth.
Right.
And so I'm not saying that we're complacent about the trade war, because if we get anything like the kind of scenarios that have been mooted from time to time coming out of the U.S., there will be a severe economic implication. Right? And recession, we'll see, but definitely a cost. And that's not good for anybody.
Bill, the next 10 years for Standard Chartered, what does that look like?
I think it's going to be a glory decade, actually. I really do. And so right now, the core of our strategy is focusing on the affluent population in Asia, Africa, the Middle East, and focusing on global corporations' cross-border needs, but with an anchor in Asia, Middle East, and Africa. But we have a big business in the U.S. and Europe. Both those things feel really good right now. Structural growth in both demographically and in terms of wealth creation in Asia. In particular, global Chinese and Indians, but it's everywhere. And the cross-border needs are getting more and more complex, and we've got a very, very relevant role to play. So. Now, obviously, lots could disrupt that period, but if we get it right on our core infrastructure is actually very good. We have single sets of systems to serve those clients. We've got to incorporate everything AI and data related effectively. Jury's out whether we can deliver. I'll make the bet that we can. And then we have to navigate some of these geopolitical tensions. And I don't see the U.S. and China bifurcating. I see constant antagonism and disintegration, but bifurcation is many, many years out, if at all. And in the meantime, there's lots of roles for a player like us, which is global.
Bill Winters there, the chief executive of Standard Chartered, speaking to me a little bit earlier. Now, Microsoft has cut an additional 300 jobs just weeks after its largest layoff in years, where the tech giant slashed 6,000 roles. The cuts underscore the industry's efforts to trim costs, even as it plows billions of dollars into artificial intelligence, while Microsoft and peers, including Meta, have touted the effectiveness of AI-assisted coding tools in speeding up the software development process. Coming up, Polish Prime Minister Donald Tusk calls for a vote of confidence after an electoral defeat over the weekend. We'll have the details next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The White House looks to dial down trade concerns, saying Presidents Trump and Xi will talk soon. The OECD slashes its global economic forecast as President Trump's trade policy take their toll. Plus, the Dutch government collapses while in Poland, the Prime Minister Donald Tusk calls a confidence vote after his candidate lost the presidential election. Now, we'll have plenty more on that story, but Polish Prime Minister Donald Tusk says he will seek a vote of confidence in his government.
Over 20 million Poles elected a new president of the Republic of Poland, showing their strong commitment to democracy and its key principle, free and universal elections. No matter how we judge the winning candidate, we should recognize his victory and congratulate his voters, which I hereby do. I also thank the loser for his determination and fighting for every vote to the end.
Well, Oliver Crook now joins us to talk about the latest. So, Ollie, what is Tusk's motivation for this confidence vote?
This is Donald Tusk's attempt to basically shore up confidence in his government, in his coalition, in his cabinet after his ally in the Polish presidential election lost by less than 1 percentage point in favor of the hard right candidate from the Law and Justice Party, which is the party that Donald Tusk himself replaced about 2 years ago after 8 years of rule. And this is really a big blow to Donald Tusk's liberalizing agenda, and it really would have made life a lot easier for him if he had the president on the same side. Because of the Polish system, you have a huge amount of veto powers from the presidential side of things. So any legislation that Donald Tusk puts forward that the president doesn't really like, he can very easily veto. There's also powers of appointing the central bank governor that lie with the president. This has been an issue in Poland in the past where there's been claims of politicization ahead of elections, that basically monetary policy is pulling for one side or the other. And then, of course, there is the big question of billions of euros worth of EU funds that were basically re-released to Poland on the idea that there would be more liberalizing, particularly in terms of judicial reform. That is potentially also at risk. So these are all the issues that now Donald Tusk needs to deal with, which he would not have to have dealt with if the vote had been different by 0.9 percentage points. Very, very close race.
Ollie, elsewhere in Europe, the Dutch government collapsed this morning after failing to reach an agreement over migration. What happens next?
This is the perennial issue in Dutch politics. It's what has brought down the government several times in the past. Geert Wilders, the head of the Freedom Party, has threatened to pull down the government. Even earlier this year, back in February, he did not pull the trigger. He did pull the trigger today. This is the biggest party in the Netherlands. This is the far-right party that is anti-immigration, anti-Islam. He put forward a 10-point proposal to deal with immigration, being very frustrated by the pace at which the government had been dealing with it. And some of those points on the proposals were to use the military to guard basically the land borders of the Netherlands, turning away all asylum seekers, temporarily halting family reunifications, sending Syrian refugees back to Syria, which he now deems a safe place for people to be going, closing the borders basically to all asylum seekers. These are some of the issues that he said, if you do not pass at least the majority of this 10-point plan, I'm going to pull the plug on the government. And that is exactly what he did just over an hour ago on X, saying that he's now leaving the government. This now precipitates another election, which will automatically be triggered. And we should say that he right now in his party, the Freedom Party, is polling #1 in the Netherlands, in part probably why he feels bold enough to call this election, though he will lose a number of seats. You know, in the last election, they had 37 seats. They're now polling at about 31. But Geert Wilders feeling empowered to pull the plug on this government and now threatening an election. We should say just 3 weeks before Donald Trump is meant to arrive in the Netherlands for that NATO meeting.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on Poland, the Netherlands, and NATO coming up. Now, nearly 1 year into Britain's Labour government, sentiment in the City of London seems to be shifting, with new tax rules seeing an exodus of wealthy non-doms. Meanwhile, asset managers are pushing back on mooted pension reforms, and a much hoped for boost to deals has actually yet to materialize. So here to take stock of all of this and more is one of Britain's most powerful bankers, Tiina Lee, Citi's UK Chief Executive. Tiina, as always, thank you so much for being with us. Look, there's a lot of things going on. I know we've spoken in the past about the UK. It's almost 12 months since the Labour government have come in place. What kind of impact have their policies had on the City of London?
So they've done a lot. They really do have an ambitious growth agenda, which has followed on really from the prior Conservative government and the actions they took, particularly around the Mansion House Compact and listing rules, for example. But there's still an enormous amount to do. So if you sort of think about some of the reviews that we're about to see, both in terms of the pensions investment review and also the financial services growth and competitiveness strategy, there's still a lot to play for, and the government has been very open in terms of engaging with the industry. At the end of the day, financial services is a key industry for the UK, but not only as a sector in itself, but also as a powerful transmission mechanism for capital and investment to other sectors in the country.
Tiina, what's your business like actually here in the UK? I know there's an overlay of uncertainty because of trade, because of volatility in the markets. Chief executives don't really want to spend that much. But are you confident that IPOs will come back to the UK and the City of London?
Absolutely. Look, I mean, there's a couple of things. I think when I think about the UK IPO market, you know, clearly, as we've seen across the piece, there has been a delay in terms of investment decisions, in terms of coming to market. So transactions that we thought or were hopeful that would be executed in 2025, are still absolutely in the pipeline, but are more marked in for 2026. But at the same time, anecdotally, we are hearing from clients that actually there's fewer inquiries about US listings, a desire maybe to stay a little bit closer to home. So that, of course, is a real opportunity for the UK. And I think it's also important to note that, of course, the IPO market isn't the only thing that is here in the City of London. So when we're speaking to clients, whilst there may be delays, for example, in big long-term investment decisions, delaying capex, for example, because we know that rewiring supply chains just takes a long time. At the same time, we're seeing a lot of clients that are thinking about how to rebuild their balance sheets, increase liquidity, and of course using Citi's global trade platforms to mitigate any short-term supply chain pressures.
Does a rebound in IPO in 2026 go hand in hand with M&A?
Absolutely. So we have seen a pause in M&A, particularly after Liberation Day. So no surprises there. But at the same time, particularly in terms of sponsor IPOs, we do see a pretty healthy pipeline for 26.
Tiina, HSBC recently debuted this new loan that helps US clients cope with the price of tariffs. I mean, is there something that more banks should be doing? Is this something, the disruption in trade, is it here to stay? And have you had any UK clients actually asking for mitigation or services like that?
Certainly not at this point. So when we actually think about the impact on tariffs, and again, what we're hearing from clients is that, more broadly, a permanent 10% tariff rate is something that our clients and their consumers can probably bear. Anything that's sort of 25% and above certainly requires a different type of calculation. But in terms of taking those strategic long-term decisions, actually our clients are saying, look, we need a lot more clarity, a lot more certainty before we actually, pull the trigger.
I mean, I guess, because of the trade and uncertainty, it's not great for IPOs, M&A, but it's great for trading revenue.
Absolutely.
And that continues?
That's right. So we've seen tremendous momentum in Q1. We've seen a lot of market activity. So again, when we think about what our UK clients have been doing, they've been increasingly hedging across asset classes, in particular G10 rates, core currencies, as well as commodities. And we've also seen pension funds and insurance companies just begin to edge away slightly from the US towards other areas, for example, Japan, India, and of course parts of Europe, including the UK.
Have you had, clients question the fact that you are a US bank, or has there been some of the European banks say, look, they're hoping to win business because they're European and, there's maybe more of a heart pulling towards a domestic bank. Have you seen anything like that?
None whatsoever. I mean, Citi is in really, I think, quite a unique position. We've been on the ground and are on the ground in 94 different countries, in some cases for over 100 years. So what that means is that whilst we are a global bank, we are very often the only foreign bank that is on the ground locally. So what that means is that we're in actually quite a unique position to advise clients through this uncertainty.
When it comes to your staff in the UK, is there any unsettled, staff because of the proposed changes to the settled status? And actually, what would be your preferred outcome?
So we have heard nothing on that front at this point. Of course, we have a whole mix of nationalities that are located in the UK. We don't believe it would make a considerable difference. What I would say is that we're continuing to hire and make sort of strategic senior appointments in the UK. We recently hired a new head for EMEA ECM, of course, located out of London. We've appointed a new head for our global asset manager group. Financial sponsors are a key focus for our investment bank, and we've appointed a new head for our wealth business here in the UK. So in terms of senior leadership in the UK, it's never been stronger.
Have the non-dom rules affected either staff or actually clients a lot in the UK?
Very little impact in terms of staff. We know that our people are committed here for the long term, so they don't come for 3-4 years, and we have many nationalities that have been here for decades. What is interesting is, of course, from our wealth business, we continue to monitor whether there are clients deciding to move out of the UK into other jurisdictions. We've seen that selectively, but we still continue to have a considerable number of clients for whom the UK is their home.
Do you think the government is very in tune with some of these changes? Will we see a recalibration when it comes to some of the rules on that?
It's one of the topics that we continue to engage with government about. We're very fortunate in the sense that we see these flows firsthand, but I think it's also important to acknowledge that the government is also in a very tight fiscal position and therefore have very limited options with regard to how to maximise the tax take. So when I think about the UK and I think about the government, really it's less about fiscal policy now and probably more about monetary policy.
You've been in banking for quite some time. What makes you most nervous about now? I know that, a lot of chief executives point to, the fiscal situation and actually a bond auction that could go sour in the U.S. and maybe, in fact, also things here in the UK. Others say it's the flow of capital. It's the fact that it's now a new world order where we don't know where globalization goes. What do you concretely worry about?
So we do think a lot about the fragmentation of the global system. We've always been of the view that we are moving into a multipolar world. And actually what has happened since the beginning of the year has only reinforced that point. But for Citi, that just means there's only opportunity. We have clients everywhere. So it's actually just helping them navigate through that uncertainty. But certainly it's something we're continuing to monitor. But at the end of the day, we're a US firm. And when we think about the US, it still has incredible advantages. So whether that be deep capital markets, a very flexible labour market, or of course an incredible entrepreneurial spirit. So the US isn't going anywhere, but certainly the geopolitics is going to be super interesting for the years to come.
Yeah, and we're also seeing a bit of more closeness between the UK and the EU from a governance standpoint, but also the Bank of England last week weighed in saying there should be stronger trade ties.
That's right.
And that makes a difference.
It absolutely does. Certainly, I think the summit that we saw last month between the UK and the EU was a welcome first step in terms of further collaboration in what are really strategic areas such as defence and security. And of course, don't forget the UK-India trade deal. India is one of the fastest growing countries in the world, so that's a big win for the UK. And of course, the trade agreement with the UK and the US. We're very hopeful as well that there will be an agreement around tech. So I think that there are absolute wins that the UK has been able to achieve in the last couple of months.
Tiina, on the slight changes to the pension funds, does it make not maybe a material difference, but does it change risk perception? Will that lead to more, retail investors and just a risk appetite for the UK?
We are hopeful that it will. Citi has long advocated for a consolidation of pension funds. The landscape is highly fragmented in the UK, so the creation of mega funds with assets under management of £25 billion or more certainly is welcomed. We believe that will reduce costs, increase efficiency, but most importantly allow diversification of investment assets into alternative asset classes such as private equity or indeed infrastructure.
Tiina, thank you so much, as always, for joining us here on Bloomberg. Tiina Lee there, the Citi UK Chief Executive. Now, back to politics, and Russia and Ukraine have laid the groundwork for a new prisoner exchange. That's after a second round of direct talks in Istanbul failed to bring the two sides closer to ending the war. Now, it comes one day after Kyiv staged one of its boldest aerial attacks inside Russia. Greg Sullivan, our Russia government and economy editor, joins us now. Greg, thank you for joining us. So was there any progress towards peace or even a temporary ceasefire after yesterday?
Well, on the face of it, it appears that the two sides are no closer to a ceasefire agreement, despite the second round of talks. The biggest thing to come out of this round of talks was an agreement to prepare a prisoner exchange, especially of the heavily wounded and younger prisoners, those under 25, as well as an exchange of the war dead. In this, it sort of mirrors the first round of talks that happened in Istanbul, where the biggest thing to come out of that was also an agreement on a prisoner exchange and not a ceasefire. That being said, both sides did exchange a memorandum that laid out their points and positions needed to move towards a ceasefire. That was expected from this meeting. Ukraine did say they would take back the Russian two-part memorandum and study it, and did propose another meeting later in the month. Now, it is important to note that this round of talks is happening to the backdrop of intensified fighting. Russia has really upped their missile and drone attacks, the intensity of those strikes on Ukrainian cities. And of course, we saw the most audacious Ukrainian operation within Russia striking those strategic bombers. So even as the talks continue, the fighting does not seem to be abating.
Greg, thank you so much. Greg Sullivan there with the very latest on Russia, Ukraine. Now, South Koreans have been at the polls today to elect a new president. It comes after an attempt to impose martial law at the end of last year triggered its worst constitutional crisis in decades. Sherian has the latest from Seoul.
One of more than 14,000 polling stations across South Korea. This one is an elementary school in central Seoul where voters cast their ballots for a new president. South Korea has gone through 6 months of a leadership vacuum that hit the economy and deeply divided society. Voters are focused on the candidate's economic policies. One 32-year-old man I spoke to here explained the importance of housing policies for young people and the big economic and political gap between the older and younger generations. Leading candidates Lee Jae-myung and Kim Moon-soo have both pledged billions of dollars of new stimulus measures, a big fund to support the tech sector, and prioritizing a trade deal with the United States. These expectations have led to a rally in Korean assets in the lead up to the vote. Promises of corporate governance reforms from candidates have also spurred optimism in the market. Whoever wins, however, will have the challenging task of balancing ties with the U.S. and China. Lee has pledged pragmatic diplomacy based on a strong alliance with the U.S., but also stable relations with China and Russia. Sherian, Bloomberg, Seoul.
That was the latest on the South Korea elections. Now, coming up, the OECD slashes its global growth forecast, citing the impact of tariff onslaught. We'll have more of the details on that next. And this is Bloomberg. Well, a new report by the OECD finds that Donald Trump's combative trade policies have tipped the global economy into a slowdown. Now, the organization forecasts global economic growth to slow 2.9% this year from 3.3% last year. With us to discuss these findings, the OECD chief economist Alvaro Santos Pereira. Mr. Santos Pereira, thank you for joining us. What worries you the most going forward about the world economy?
Well, good morning, everyone. First of all, I think the key word is uncertainty. There's been a huge increase in trade and economic policy uncertainty. This is having an impact on consumer confidence, on investors' confidence, and also on activity indicators. And if you take this into account, and you take into account our own estimations about the impact of tariffs going forward, we revise down almost everybody. It doesn't matter if you're a G20 economy, a non-G20 economy, small or big. Almost everybody was revised down, and was exactly because of difficult circumstances and all this uncertainty going forward.
It does seem that a lot of the uncertainty comes from the U.S. Because this is man-made. Could the reversal come quite quickly?
Well, we do have a scenario. In fact, we take into account the possibility that trade barriers coming down. We think that the top policy priority is exactly to avoid further trade fragmentation. So basically, to avoid increasing trade tariffs, trade barriers going forward. And in fact, to get an agreement, sit down on the table, get an agreement so that we are able to bring down trade barriers. If we do that, we would expect that growth will be brighter than we are forecasting right now. At the same time, there'll be less inflationary pressures. But if we continue to insist of having increasing trade barriers, this will lead to a decrease in growth in the world economy in most countries of the world. At the same time, that will have additional inflationary pressures in the economy.
Yeah, but because of the downgrade to global economic growth, is this actually the worst slump since the global financial crisis, maybe excluding COVID?
Well, it is since COVID that it has been the lowest growth rate of for the world. It's one of the lowest growth rates since the global financial crisis. Usually, when the world economy was at cruise speed, used to grow around 3.84%. Right now, we're talking about lower than 3%, which means that there's a part of the world that is not growing much, and then that means there is not enough jobs being created, and there's not enough prosperity going forward. So that's why we think it is absolutely essential to get an agreement so that we are able to bring down trade barriers, but on second, to focus on policy to revive investment, which has come down significantly after the global financial crisis. Just to give you an idea, just in OECD countries, investment came down for more than 22% in OECD countries, and for EMEs, the cut in investment was around 33%. So massive decrease, which got even worse with COVID. So reviving investment is key.
I mean, how do you see it going forward? If the U.S. downgrades seem particularly hurtful, so why do you see it so weak going forward? And is it entirely on the trade tariffs, or is there also more structural things, maybe post-COVID, that could explain it?
Well, it is explained by what we see in terms of business indicators and consumer indicators. It is also explained by the impact of tariffs and in the short-run impact, which according to our own models, lead to lower growth. And so that's why we think that it's advantageous to everyone, including the United States, to get to the table and get the agreement. On the other hand, there's an upside risk that we think it could be quite important, which is the diffusion of AI and an investment in AI. And this is an area where there's a widening gap in terms of productivity between the United States and the rest of the world. China is also in the lead here. But if the investment in AI continues, this will likely bring more productivity and more growth.
Has the trade uncertainty inflicted some lasting damage, actually, on the global economy, even if some of the trade policies are reversed?
Well, I think certainly the effect is the short run in terms of uncertainty and all these indicators. But let's put it this way. If in the next few months countries get together and are able to sign trade deals that bring down significantly trade barriers and tariffs, this will give a boost to the world economy. Together with the boost that could come from AI, that means that likely we're going to have much brighter economic outlook going forward.
Mr. Pereira, what surprised you the most, actually, in putting together this growth outlook? I know India is meant to have one of the biggest growth numbers going forward. Is actually India the new China?
Well, India is certainly the champion, the growth champion of the G20 right now. And India is investing in many areas that I think will be the future. And so you see very strong investment in India. The thing that I like the most about India is the reforms. In the last 10 years, there's been massive reforms in terms of taxes, in terms of also competitive federalism, and right now also part of the property rights reforms and so on. These are this reformist attitude is bringing a lot of growth, and we expect that this would entail even more growth in the future for India.
Yeah. And very quickly, in 30 seconds, how much do you worry about the UK? I know, the thin fiscal buffers are something that may put some people sleepless at night.
Well, the most important, I think the key for the UK is going to be boosting productivity, keeping fiscal discipline. We think that, as long as fiscal discipline is maintained is important, but most important, how can the UK boost productivity? So investing in AI and the new technology is going to be absolutely key. So, and also to address skill shortages. So I would focus on that.
Thank you so much, Alvaro Santos Pereira, there, the OECD chief economist. Now, tomorrow and Thursday, Kriti Gupta will be at Super Return, private equity event in Berlin, speaking to some of the biggest names in the industry. We'll talk credit. We'll talk, of course, the revival and some of the debt issues out there. Up next, Bloomberg Brief, and this is Bloomberg.